Sometimes having really clear milestones and maybe even taking the time to celebrate those milestones once you've paid it off along that time might, help make it feel a little less arduous. So it's like, okay, we've reached this level, now we've reached this level. And that can sometimes help in terms of your mindset towards, oh, I still have this amount to pay off. It's more acknowledging how much you've already paid off. This episode is sponsored by Saxo Markets. Hello and welcome to the Investing Insiders podcast, where we help you achieve financial well-being by making smarter money decisions. I'm Brianne, and in today's episode, we're going to be unpacking some of your money dilemmas. We get lots of questions into our inbox, and it's great to hear from you. So we're going to dedicate this episode to answering a few of those queries that we've had through. If you've got a money question which you'd like us to unpack, send it into podcast@investinginsiders.co.uk and we'll try to get to it on a future show. Before we get started, it's important to note that the information shared during this episode is for general information and educational purposes only and shouldn't be considered financial advice. Any products, providers, platforms, funds, or any services that we mention are for illustrative and informational purposes only. They're not recommendations, endorsements, or any indication that they're suitable for your personal use. As always, we'll empower you to do your own research. And if you're unsure about what's right for your situation, there's always the opportunity to consider speaking with a regulated financial advisor. So with all that being crossed off, let's get into the show. So our first question comes from Sandra. Sandra asks, where should you start with investing small sums of money? Okay, Sandra, that is a great question. And if you're already financially set to get started with investing, there are a few steps that you can consider to get going. So the first one to bear in mind is choosing a platform. So an investment platform basically gives you access to different investment assets. And an investment asset is essentially a share or a bond or a fund. And these are the things that you purchase when you start investing and try to generate some kind of return. So it's important to shop around for your investment platform to make sure you find one that actually suits your needs. Some of the things that you might want to look out for, particularly if you're going to start off with smaller sums of money, are the fees that you're going to have to pay when you buy, sell, or hold on to these investment assets. That's because the fees that you pay are going to affect how much money you actually get back. So once you've had a look around and you've compared different investment platforms, the next thing that you'll need to do is apply for an actual account. So there are two main types of investment accounts in the UK. There's the General Investment Account, or a GIA, and a Stocks and Shares ISA. So taking a look at a Stocks and Shares ISA, it's a financial product that allows you to invest up to £20,000 of your ISA allowance each tax year without having to pay any tax on the returns that you make. And the tax year runs from April 6th one year to April 5th the following year. So with your Stocks and Shares ISA, you can hold different types of investments in there, and as long as it's within your ISA allowance, it shouldn't attract any additional tax that you'll need to pay. With a general investment account, you may need to pay tax on your returns depending on how your investments perform. So some of the taxes you might need to pay are things like dividend tax, income tax, or capital gains tax. So that's just a brief overview of the different types of accounts available. Once you've had a look and decided what type of account is right for you, you'll need to go through the registration process. Most of these investment platforms allow you to apply online. So they'll ask you for proof of ID, things like your passport, and proof of address. So something like a household bill, a recent council tax statement, or, bank statements, things like that. And you'll put them through the process and eventually get a answer as to whether or not your registration has been successful. Once that's all gone through and been accepted, the next step is to actually start investing. So once you're all set up, most accounts or most investment platforms will allow you to register how you want to put money into your account. So this might be through paying by a debit card, so putting your debit card details in, or you might set up, you might do a bank transfer. So transferring money from your bank account into your investment account. Or you can also set up a direct debit. So the direct debit, you can put in how much money you want to fund your account with. Each provider has their minimum amount that you'll need to put in. And once you set that, the money kind of goes out without you having to think about it. And once you've got enough money in your account to start purchasing investments, have a look at some of the educational resources each platform has. So each platform will give you different market updates. They'll give you information about the different types of investments. They'll allow you to have a look at the previous performance of certain investments as well. Although, do remember that past performance doesn't indicate what the future performance is going to be. It's just a guideline. And it's important to think about it in the wider context of how you want your investments to perform. But just really get into the mindset of an investor. So what things are important to you? You might want to invest in a particular type of company or a particular geography in the world. If you're thinking about certain areas or certain countries that you want to invest in, that's something that you can bear in mind as well. Another thing to think about is the impact that you want your investments to have. So if you're considering having or trying to look for companies that are slightly more ethical or sustainable, that's something that you can factor into your decision making when it comes to deciding the best types of investments for you. And once you've purchased your investments, they'll be inside your account. And then you move on to the next step, which is monitoring the results. So one of the things with investing, it changes. So sometimes depending on what you've bought, so say you've purchased some shares, you might see the value of those shares go up and you might see the value of those shares go down. And it's important to just observe and have a look at that over a long-term horizon. So when we're thinking about investing, we're usually thinking about money that you might not need to access for at least 5 years. So just having a look at how this money behaves with this company or with the fund that you're in, and just getting a feel for what it's like to see that value change, because sometimes it can be quite an emotional experience to see, oh my gosh, this was worth X yesterday and now it's fallen to Y today. That can be something that needs to be built on, and managing your expectations and understanding the things that go into investing generally. And over time, that will help build up your confidence as an investor and help you to build out your portfolio. Perhaps you'll stay with the provider that you're with, or maybe you might get to a certain point and think, okay, I think I might want to transfer to somebody else. So that's another thing to bear in mind, that the provider that you go with in the beginning might not necessarily be the provider that you stick with. As with bank accounts, you are able to switch to different investment platforms. Each platform has its own rules around how that process takes place. However, there are options out there, and sometimes you might get a bonus for switching to different providers as well. But for the meantime, just running through those steps and getting a feel for what it's like to invest will just help you build that confidence and see, hopefully, things grow and help you understand the different aspects of what it means to invest in certain companies, what it means to observe levels of growth, loss, and also that you can pivot your investment strategy. Even if you don't necessarily start out with one, you can maybe start building one later on. I think it's really admirable to start somewhere and build from there. And with that, experience and confidence will come. One thing that we've done to help people, especially in the early stages of investing, is to create a handy quiz which helps you understand the type of investor that you might be at the moment. And with that, it gives you a roundup of providers which might be suitable. So we'll link that in the show notes just to help you get started and hopefully find your way and achieve this aspect of your financial goals. Now on to our next question. Our next question comes from Henry, and Henry says, I live with my wife. We're in our early 50s and have an outstanding mortgage of around £150,000 with 11 years remaining. The mortgage is fixed for several years at just over 4%. I have a pension pot of around 400k and am making substantial pension contributions through salary sacrifice. Between my pension, my wife's pension, and our expected state pension, our retirement provision is broadly on track. From a purely financial perspective, continuing to prioritize pension contributions feels like a logical choice due to the tax advantages. However, I really dislike having a mortgage and keep feeling drawn to making significant overpayments on that instead. Would you continue prioritizing pension contributions, or would the psychological benefit of reducing the mortgage change your approach? Well, Henry, that is a fantastic question and touches on a lot of different points, particularly the emotional and psychological side of money, which we've explored in previous episodes, and they are very much interlinked. So first of all, it is totally understandable to want to clear your mortgage. It carries weight sometimes, the feeling of having debt, and it's understandable to want to just clear that and kind of then focus on other things. I think the key parts to weigh up here are the pros and cons of each. So on the one hand, you've got overpaying your mortgage to clear it faster. And on the other hand, you've got prioritizing your pensions contributions. So generally speaking, investing and putting money into your investments, say your stocks and shares, ISA, or pensions contributions, have the ability to generate a return. And overpaying your mortgage, on the other hand, it's more of a peace of mind practice, because the way that your repayments are set up, it will be paid off at the date that, is set within the terms of your contract. So a good way to compare the financial benefits of each is to use a tool or a calculator which really helps break down paying off your mortgage earlier versus the potential returns that you could get through investing or putting money into your pension. Another thing that you mentioned as well, which is important, are the tax advantages of putting money in your pension as well. We have a mortgage overpayment calculator, which actually helps you break these down, and seeing that on paper can sometimes really just help put things into perspective and just help you understand that, eventually my repayments at this level are going to lead to me paying off my mortgage by X date. And that might help give you a little bit more peace of mind when it comes to weighing up these different things. Another option to consider is speaking with a professional financial advisor who can offer tailored insight into the best option for you and making sure it's aligned with your long-term goals as well. So just having all of these different data points ready, again, can just help paint the picture of how you could manage your finances in a way that really suits you and your wife as well. And if after doing the sums for yourself using a calculator and speaking with an advisor, if you still feel like, the mortgage is causing a sense of unease, it might be worth digging into why that is and just helping you maybe reframe what it means to have this mortgage for the amount of time, I think it was 11 years, that it's going to, potentially be there. Sometimes having really clear milestones and maybe even taking the time to celebrate those milestones once you've paid it off along that time might, help make it feel a little less arduous. So it's like, okay, we've reached this level, now we've reached this level. And that can sometimes help in terms of your mindset towards, oh, I still have this amount to pay off. It's more acknowledging how much you've already paid off, which is an incredible achievement. And just really repackaging and refocusing the attention off of, oh my gosh, there's this much left to pay. Maybe focus on what you've paid already. And at that point, you're still reaping the benefits of contributing to your pension and generating hopefully enough of a return, which is going to ensure that you have a comfortable retirement that meets the lifestyle that you want to have when it comes time to do so. So, just in summary, it's completely understandable to feel that sense of unease when it comes to having debt. Doing the sums using a calculator, I'll link it in the show notes, it will really help you get clear on what the benefits of each one will be. If you're still feeling a bit unsure, speaking to a professional advisor offers the opportunity to really dig into the numbers, talk about your goals, and see if there's an alignment with either option. And then if, contributing to your pension does come out best, but you still feel that heaviness, then just maybe try and rethink what this mortgage means and why it is that is causing that unease. I hope those tips help and you find which option works best. Thanks so much for messaging in, Henry. Our next question comes from James. James says, I'm planning a trip abroad in a couple of months' time. Is it worth dealing with travel exchange companies for cash, or are there better cashless options now? Thanks. Hi, James. That is super exciting, and I hope you have a lovely trip planned. It's a really great question. And when it comes to travel money, there are a few things to bear in mind before making your decision. So it depends on where you're traveling to. So is this a place that operates mostly cashless? Will you need cash mostly, or is it a bit of both? Like, will you be able to pay for things cashless and also maybe need cash for, say, markets, or if you need to leave a tip or something like that? It also depends on how long you're going away for, so how much money you'll need. And one of the more personal points is, how do you like to manage your money when you're traveling? That's another big one to consider. So kind of breaking it down into different points. Going cashless, what are the pros and cons of it? So generally speaking, paying by card, it offers a bit more convenience and you don't have to worry about exchanging your money when you get back to the UK. So there is the convenience element of it. Some banks actually allow you to take money out when you're abroad in foreign currency without you having to pay an exchange fee or banking fees. So some of these providers include places like Monzo, Starling, Revolut, or Chase Bank. Each provider has its own withdrawal limits, though. So if you do decide to rely mostly on card, it's important to understand what those limits are before you go away and make sure they're in line with how much money you'll need to be taking out when you're there. If you decide to exchange currency before you go, changing money before you go abroad, it just gives you instant peace of mind. So you won't have it in the back of your head that, okay, now that I'm here, I need to find a cash point or, a currency exchange place. It's already there with you. So you don't have to worry about that too much. If you do decide to exchange cash before you go, just make sure you compare different rates. There are lots of currency exchange comparison websites available online. Make sure you watch out for any fees that might need to be paid. So some places might try and charge a commission or something, and that will affect the amount of money that you get back. If you do really want to take cash before you get there, make sure that you don't use currency exchanges at the airport. These tend to offer the least competitive rates. So you're not really going to get value for your money if you decide to exchange money there. Obviously, there are, emergencies happen. And if it's the only option available and you desperately need cash, it's all that's there. But really try to avoid that if that's the case. Leave enough time to compare different places, make sure you can get hold of the cash and get good value for money before you go away. And the thing is, when it comes to travel money, you don't have to just settle on one thing. You can get the best of both. So you could have some cash on you, maybe for emergencies, or if where you're going to has a big tipping culture, like at least you've got the money on you ready to go. And then you can still pay by card most of the time. So you can balance both. It just takes a bit of time thinking about what, type of budgeting experience you prefer when it comes to managing money abroad and what options are available when you get there too. And whatever option you decide, just make sure that, if you're going with your card, your provider allows you to make payments without incurring a fee. Most high street banks offer fee-free spending abroad now, but always check before you travel just to make sure you don't get caught out by anything. Thanks again, James, for messaging in your question. Really hope this helped. We have a question from Candice. Candice asks, should you prioritize getting on the property ladder before starting a family? Candice, this is a very big question. Thank you so much for messaging in. The short answer is it really depends. It depends on what your overall life plan is and what your financial aspirations are. So thinking about if you want to get onto the property ladder, what does that look like? What steps are you going to need to take to get there? Making sure that you're on track to get your house deposit together, your credit scores in order, so that when it comes to applying for a mortgage, you're able to access more competitive deals. It's not a deal breaker, but the better your credit history, the higher your chances of getting a more competitive interest rate on your mortgage will be. And just also thinking about what type of lifestyle you are trying to create when you have a family. So one of the things to bear in mind, and it's something that we've spoken about on the podcast previously, is how much earnings, you'd have to factor in to potentially losing once you start a family, and what will childcare arrangements look like if you're living with a partner, or, if you can share childcare with family, what does that all look like? It's not a binary yes or no answer, but I think it starts with just getting very clear on what your life goals are, what your financial goals are, and make sure that you're building towards everything at the same time. It is possible to do things concurrently. You don't necessarily have to have one thing secured before you start the next thing, but if it's important for you to do so, then that's definitely something to factor into your decision making as well. So there are lots of different moving parts, and you might, start saving or be on your way to saving and decide you want to do something else. You might decide to relocate or just have a change in your lifestyle, and that's totally fine too. But just, I think, being very clear on what the financial goals you have are. And again, if you're with a partner, having those conversations and just making sure that everything balances out. So if you do end up taking time out of work to start a family, making sure that you're still contributing to your pension, that you are applying for things like child benefit to make sure that you're getting state pension credits towards your entitlement as well. There are just lots of different ways to kind of plan it all together. So it doesn't have to be either or, but just taking that time hopefully should help you find the right answer for you. And the final question comes from Amber. Amber asks, I have a lump sum for my daughter in a child savings account, and the bank is letting me know that she'll be 18 soon and I'll need to move the money. I'd like to know, is it best to put the money into a savings account, or should I use a trust for her? So, Amber, this is a really good question. And yes, once your child turns 18, they'll need to move their money into an adult current account, savings account, or ISA. So it is really important to shop around and make sure that the lump sum goes into an account that's going to help with what you have planned for your child. So if they're looking to keep saving, then put the money into a good interest paying savings account. Make sure you shop around and compare for good rates rather than, just letting it sit in, say, a current account that doesn't pay any interest. Just making sure that the money is in a position to generate a return. Thinking about things like ISAs, if your child was thinking about investing once they hit 18, putting that money into a stocks and shares ISA could be a way to get started. You could also do a bit of both, have money in savings and also put some into a current account for whatever they have planned next in life. For example, if they're going to be doing an apprenticeship or going to uni, doing traveling, starting working, having this money set up in different areas so that they can have easy access if they need it, but then also having some generating wealth are some options to consider. Now, setting up a trust is also possible, but the rules are quite complex. So with that, you need to sit down with somebody who can talk you through the different mechanisms that need to be in place and whether or not it's actually something that's right for your circumstances. So it's definitely worth speaking with an independent financial advisor when weighing up the options with the trust specifically. But just having a think about the different accounts available. And if you haven't done so already, it might be a good idea to engage your child in conversations about, okay, well, what happens next? We've been putting this money away in a child savings account, and now it's your time to kind of manage it for yourself. So I don't know how involved they've been before in the savings journey, but just maybe when you're looking at the different options for them, thinking about, okay, let's compare these accounts together. Okay, let's have a chat about this together, and making it a family decision or a collective decision that they feel empowered with and can go off on their own journey to find out more about how do I budget if they've got certain goals in life. So they're thinking about, do I want to buy a car or, finance this thing or buy a house eventually? Having these conversations now, especially them getting all this responsibility, sets them on a good track to remember, okay, so I've got this money saved or I'm investing this money for this purpose. And it just helps direct their focus. So when it comes to thinking about budgeting and making sure the money's going in the right places and not overspending, they've got a clear focus so they know, okay, this is for this is for that, and this is growing in the background. And it just helps set them up with some good money habits that should hopefully help them in the future too. Thanks so much again for your question, Amber. We really hope that helped. Thank you so much for tuning into this week's episode of the Investing Insiders podcast. And a massive thank you to everyone who has been sending in their questions. If you've got a money question that you'd like us to answer, send it into podcast@investinginsiders.co.uk and we may answer it on a future show. This episode of the Investing Insiders podcast is sponsored by Saxo Markets. Saxo provides access to a broad range of global assets through a sophisticated trading platform. You can trade US stocks from as little as $1 per trade and UK stocks from $3 per trade. Please remember that all investing involves risk. The value of your investments can go down as well as up, and you could get back less than you invest. Terms and conditions apply. Visit Saxo Markets to learn more.